You are in a fund accounting interview. The interviewer slides a NAV pack across the table and asks one question. Why did NAV move this month? You answer, NAV increased by $3.2 million. The interviewer looks at you and says, I can see that. I'm asking you why. That is where the interview really begins. Because calculating NAV is one thing, explaining what moved it is something else. So the interviewer gives you 5 events from the month and says, walk me through them. Tell me what happened to NAV and tell me why. First event, the fund calls $10 million dollars from investors. The cash arrives in the bank. So, did the fund just make $10 million? dollars? No, cash increased. But investor capital increased as well. That $10 million dollars came from the investors. It was not investment profit. So, if you look only at the bank balance, you can completely misread what happened. That is the first trap. Cash moved. But cash movement does not automatically mean economic return. Then comes the second event. The fund uses $8 million dollars of that cash to buy an investment. $8 million dollars leaves the bank. The interviewer asks, did NAV fall by 8 million? It sounds logical. Cash went down by 8 million. But the answer is no. Why? Because the fund did not simply lose $8 million. dollars. One asset changed into another. Cash went down by 8 million. The investment asset went up by 8 million. Everything else being equal, the fund has not become $8 million dollars poorer just because it invested the cash. That gives you a rule I would remember in every NAV discussion. Do not ask only whether cash moved, ask what moved with it. Now the interviewer changes the situation. A month later, that $8 million dollars investment is valued at $11 million. dollars. No sale, no distribution. No cash has entered the bank. The interviewer asks, can NAV still increase? Yes, and this is the part that catches people who are watching cash instead of economics. The investment moved from 8 million to 11 million. That is a $3 million dollars increase in value. So, all else equal, NAV increases by $3 million dollars through the unrealized gain. No cash came in, but economic value increased. That is a market or valuation movement. And now the interviewer asks you the opposite question. What if no investment value changes at all, but the fund records a $500,000 management fee? This time, the management fee is an expense. Net assets fall. So, everything else being equal, NAV falls by $500,000. Notice what just happened. In one example, no cash moved and NAV went up. In another, an expense was recognized and NAV went down. The answer was never hiding in the cash balance. It was hiding in the economic driver. Now the interviewer gives you the fifth event. The fund distributes $4 million dollars to investors. Cash leaves the fund. NAV may reduce as capital is returned. But the interviewer asks one more question. Did the portfolio suddenly lose $4 million? dollars? That is where many candidates mix up NAV movement with performance. And the answer is not necessarily. Because a distribution can reduce fund level NAV or investor capital without meaning that the investment portfolio just suffered a $4 million dollars loss. So now we have seen 5 events. Cash came in, cash went out. Value changed without cash. An expense reduced value, and capital was returned to investors. They all touched the fund differently. The interviewer looks at you again and asks, so why did NAV move? This time you need a better answer than one number. This is where I would stop thinking transaction by transaction and build the NAV bridge. Start with opening NAV. Then ask what changed during the period. Was it market movement, price changes, foreign exchange movement, or unrealized gains and losses? Was it income, interest, dividends, or payment in kind income? Was it fees and expenses, management fees, performance fees, operating expenses? Was it capital activity, capital calls, subscriptions, redemptions, or distributions? Or was it timing, late trades, true ups, reclasses, or another reporting adjustment? Those are the five buckets I want in my head: market, income, fees, capital, timing. But here is what matters: those five buckets do not tell the same story. Market movement tells you valuation changed, income tells you return was earned, fees tell you value was reduced, capital activity tells you money moved between investors and the fund, and timing tells you the reporting or accounting treatment changed. That is why saying NAV increased is not enough. A reviewer already has the closing number. What they want is the bridge from opening NAV to closing NAV. Now let's run one. Suppose opening NAV is $10 million. dollars. During the month, the investment gains $3 million dollars in value. The fund also records a $500,000 management fee. Before any capital activity, NAV moves from 10 million to 12.5 million dollars. 10 million opening NAV plus 3 million unrealized gain minus 500,000 of expense, 12.5 million dollars. That is the economic bridge. Now suppose investors also contribute 10 million dollars. Closing fund NAV can rise again, but that extra 10 million is not investment performance. And if the fund later distributes $4 million, NAV can fall because capital left the fund. Again, that does not mean the portfolio suddenly lost $4 million. That is the distinction I want you to remember. NAV movement is not the same thing as performance movement. Then the interviewer makes it harder. What if this is not a private equity fund? The framework still works, but the dominant driver can change. In private equity, valuation changes and exits may dominate. In private credit, interest, payment in kind income, credit events, and valuation changes can matter more. In real estate, property valuation, rental income, financing costs, and operating expenses can drive the story. In hedge funds, market prices, realized and unrealized gains, financing, and trading activity can move NAV quickly. Same question, different return engine. So when someone asks, why did NAV move? Do not rush into journal entries. First ask, what kind of fund am I looking at? What economic driver changed? Was the movement performance, capital activity, or timing? Then explain the accounting. Now go back to the opening question. Why did NAV move this month? A weak answer is NAV increased by $3.2 million. dollars. A stronger answer sounds like this. I would start with opening NAV and identify whether the movement came from valuation, income, fees and expenses, capital activity, or timing adjustments. Then I would reconcile those movements to closing NAV and separate economic performance from investor capital activity. That is a completely different answer because now you are not just reporting the number, you are explaining the story behind it. Good fund accountants can calculate NAV. Strong fund professionals can explain what moved it. So the next time someone asks, why did NAV move? Do not start with the closing number. Start with the driver. Then build the bridge. If you are preparing for fund accounting or private markets interviews, subscribe to the Fund Desk. Here we do not stop at the number. We follow what moved it.